The patient is the US dollar.
Yeah,
Time of death is being debated, but the decay is everywhere.
that is. Well, that's a heavy way to start a Thursday morning. You're going straight for the jugular then.
I think we have to. I mean, look at the stack of research on the desk today.
Yeah.
It's thicker than a phone book, if, anyone remembers what those were.
Right.
Welcome back to the Deep Dive. It is Thursday, February 12, 2026. I'm your host, and today we are dispensing with the usual pleasantries. We are putting on the surgical scrubs
We're conducting a forensic autopsy.
on the global financial system.
And specifically on the health, or I guess the rapid decline of the American Empire's central nervous system, the US dollar's status as the global reserve currency.
Precisely. And for this investigation, we're assigning roles just to keep this organized because, frankly, the data it's messy.
It's extremely messy.
So I'm going to be the chief examiner. I've got the macro data, the history books, the charts that look like a heart rate monitor attached to a marathon runner who's having a panic attack.
So you're looking at the anatomy of the system,
Exactly. The structure, the history, the vital signs.
which I suppose makes me the investigative reporter. My job is to take that pathology report, the dry numbers, the yield curves, the debt ratios, and figure out what it actually means for the person listening to this.
Right.
Because usually when we start talking about reserve currency status or sovereign debt yields, eyes just glaze over.
People tune out. They think it's just noise for bankers in Geneva or something.
It feels abstract. It feels like weather in another country.
But it's not.
It's not abstract at all. It's the cost of your groceries. It's the value of your 401k. It's whether your 30-year mortgage is a safe asset or, a ticking time bomb.
It's about whether the money you work for today will actually buy anything tomorrow.
It is the water we all swim in.
So let's set the scene. It is early 2026. Donald Trump is back in the White House. The geopolitical landscape is shifted beneath our feet. And as the chief examiner, I am looking at the body on the table, and I see 3 specific gaping wounds on the US dollar.
3 deep, critical wounds. I've got my notes right here.
Go on.
First, we have the expiration of the petrodollar agreement, that 50-year marriage between the U.S. and Saudi Arabia. It's not just on the rocks.
The divorce papers are signed.
They're signed, sealed, and delivered. Second wound.
The internal bleeding. The debt. We are looking at a national debt that has officially breached $38.5 trillion.
A number so large the human brain can't actually process it. It's just digits on a screen at that point.
We'll try to help with that later. And the third wound is what we're calling the digital trap.
Right. The rise of BRICS, the expansion of a platform called Bridge, and a sudden massive pivot to gold and Bitcoin by sovereign nations.
This isn't just a story about bankers. This is a story about a fundamental shift in who owns the future.
And we've got rumors of a Mar-a-Lago Accord. We've got a strategic Bitcoin reserve that's actually holding assets. I mean, there is a lot to unpack here.
So let's sharpen the scalpel.
Let's dig it.
Okay. We have to start with the patient's medical history, that standard procedure. To understand why the dollar is in the ICU today, in 2026, we have to understand why it was so healthy, so, invincible for so long.
We have to go back to 1974.
Exactly, 1974, the year of the deal of the century. It sounds like a spy novel title, but this is the actual origin story of the modern world.
It really is.
Yeah.
June 8th, 1974. Let's set the context, because people forget how bad things were back then. Nixon had taken the dollar off the gold standard a few years prior, in 71.
The dollar was wobbling. It was completely unmoored.
Inflation was getting nasty. We're talking double digits.
Huh.
The U.S. needed a new anchor. We had lost gold. We needed something else.
Gold was gone. So they needed something else that the whole world needed, something that every single country had to buy, no matter what.
Oil.
The black gold.
Enter Henry Kissinger and the House of Saud.
It was a classic geopolitical quid pro quo. You have to imagine the smoke-filled rooms here.
Oh, excellent. The United States guaranteed military protection and, of course, arms sales to Saudi Arabia. We basically promised to keep the House of Saud on the throne, protecting them from Israel, from Iran, from any internal dissent.
And in exchange.
In exchange, the kingdom agreed to price all of its oil sales exclusively in U.S. dollars.
That word exclusively is doing a lot of heavy lifting there.
It's the most important word in the entire contract. Because think about what that does. If you are Japan or Germany or Brazil and you need to import energy, which everyone does to run a modern economy,
You have no choice.
you must hold U.S. dollars. If you don't have dollars, your lights go out, your factories shut down.
It created a permanent, structural, sort of artificial demand for the currency.
Mm.
It meant that even if the U.S. economy was a complete mess, everyone still had to buy our money.
Exactly. It turned the dollar into a commodity that every central bank had to stockpile just to survive.
But there was a second part to the deal, wasn't there?
The recycling aspect, yes.
This is the genius part. It really is crucial. Saudi Arabia was selling massive amounts of oil. They were drowning in dollars. I mean, they couldn't spend them fast enough in their own economy. At the time, they were a desert kingdom with a small population.
So what do you do with all those dollars?
Part of the deal was that they would take those petrodollars and recycle them right back into the U.S.
By buying US Treasury bonds.
Correct. They sold us oil, we gave them dollars, and then they handed the dollars right back to us to buy our debt. It was a perfect closed loop.
Which the French finance minister Valéry Giscard d'Estaing famously called the exorbitant privilege.
And he was right to be bitter about it. I mean, it allowed the U.S. to run massive deficits without the currency collapsing.
We could just print money to buy oil.
And the money would just come back home to finance our government. It meant the U.S. could live beyond its means for 50 years. We could fund wars, social programs, tax cuts, you name it, all because the Saudis were soaking up the debt.
It was the ultimate free lunch.
It was. But contracts expire. And on June 9, 2024, that 50-year agreement officially came to an end.
Now, when that happened, back in 2024, I remember the headlines, the internet was just screaming, the dollar is dead, right then and there.
Oh, yeah. Twitter or X, whatever, was melting down. But here we are in 2026. The dollar is still here. So was it a false alarm?
It wasn't a false alarm, but it was a misunderstanding of how these things actually work. It wasn't a sudden heart attack.
Right. It's not a light switch.
No. Saudi Arabia didn't wake up on June 10th and, dump all their dollars into the ocean, but they chose not to renew the exclusivity clause.
That is the shift.
That's everything. It wasn't a divorce. It was a shift to an open relationship.
I love that analogy. Riyadh basically updated its relationship status on Facebook to it's complicated.
Or polyamorous. Because now Saudi Arabia is open to selling oil in Chinese yuan, Japanese yen, euros, and yes, they've even looked at Bitcoin.
The monopoly is broken.
They're seeing other people.
And this isn't theoretical anymore. We have seen the evidence. We know for a fact that Saudi Arabia officially joined Project Enbridge in June 2024.
That is the smoking gun in the autopsy right there. We're going to get deep into what Enbridge is later because it is fascinating tech. But the headline is this. Enbridge allows Saudi Arabia to sell oil to China and get paid in digital yuan instantly, bypassing the U.S. banking system entirely.
So as the chief examiner, I'm noting this on the chart. The patient has lost its immune system. The automatic defense mechanism that guaranteed bottomless demand for dollars, it's gone.
And for the listener, here is why that matters. If global demand for dollars drops, those dollars don't just disappear. They don't vanish into the ether.
You have to go somewhere.
They come home. If central banks in Asia and the Middle East don't need to hold as many dollars to buy oil, they sell them. When those dollars flood back into the U.S. economy, you get inflation.
And not the supply chain inflation we saw in 2022.
No, that was about ships being stuck in ports and not being able to get microchips. This is different.
That was supply side. This is monetary.
Exactly. This is devaluation. It means the stuff you buy gets more expensive because the money in your pocket is fundamentally worth less. It's a dilution of your labor.
You work just as hard, but the check buys fewer eggs.
That's it. So that is the first wound. The shield is down.
Okay. Now let's move to wound number 2. And this one is internal. This is a chronic condition.
The debt.
The toxicology report. We are looking at a national debt that has crossed $38.5 trillion here in early 2026.
The number is so big it just sounds fake. $38.5 trillion. I mean, to put that in perspective, if you stacked $38 trillion in $100 bills, it would probably reach the moon and back multiple times.
It's just an abstraction.
But the raw number isn't actually the thing that scares me the most.
No. What scares you? Because raw numbers scares me plenty.
It's the velocity. It's how fast it's growing, and specifically the cost of servicing that debt.
The interest payments.
Right. We are projecting annual interest payments on the debt approaching $1 trillion.
Stop there for a second. $1 trillion a year.
A year.
Just in interest.
Interest. We get nothing for that. No roads, no bridges, no schools, no health care. Just payments to bondholders.
That is more than the entire U.S. defense budget.
It is. Think about that. We are spending more to pay off the bank than we are to fund the Army, the Navy, the Air Force, the Marines, the CIA, and the NSA combined.
That is insane.
And this creates a feedback loop, a fiscal death spiral, because the government doesn't have a spare $1 trillion lying around in a drawer, so how do they pay the interest?
They'd have to borrow more.
They issue more debt to pay the interest on the old debt. It's exactly like using a Visa card to pay off your MasterCard and then opening an Amex to pay off the Visa.
Eventually, the credit limit hits. Or the interest rate gets so high you just drown.
And this brings us to a concept called the Triffin dilemma. We need to unpack this because it really explains why the U.S. is in this impossible position.
Yeah.
It's a paradox named after the economist Robert Triffin.
Go ahead. Give us the explain like I'm 5 version.
Okay. To be the global reserve currency, to be the king of money, the United States has to supply the world with dollars. Everyone needs dollars for trade, for reserves, right? So the U.S. has to constantly push dollars out into the world.
And the only way to push dollars out is to buy things from other countries.
Exactly. We have to run trade deficits. We have to buy their cars, their electronics, their oils, so they get our dollars. We have to act as the consumer of last resort.
Which Treasury Secretary Scott Bessent actually used that phrase recently, didn't he? Consumer of last resort.
He did. He admitted that the U.S. absorbs the world's excess production and savings. But here is the dilemma. To supply those dollars, you have to run deficits. But if you run massive deficits for too long, you eventually destroy faith in the value of your own currency.
You can't have it both ways forever. You can't flood the world with dollars and expect them to remain scarce and valuable.
And the data shows that faith is cracking. Look at who's buying the debt now. For decades, it was foreign central banks. China, Japan. They would export to us, get dollars, and then buy our treasuries. It was a neat cycle.
I'm looking at the charts here. China's holdings of U.S. debt are at their lowest level since 2008. They're down to about $731 billion.
They are dumping, slowly, quietly, so they don't crash the market against themselves, but they're systematically exiting.
And Japan and the UK are still buying.
They are, but the biggest buyer of U.S. debt recently hasn't been foreign governments.
Who is it?
It's been the private sector, hedge funds, and specifically something called the basis trade.
Oh, the basis trade. That sounds risky. That sounds like a lot of leverage.
It is extreme leverage. Here is how it works, in simple terms. Hedge funds buy U.S. Treasuries and simultaneously sell Treasury futures, and they pocket the tiny price difference. It's pure arbitrage.
So they aren't buying the debt because they believe in the long-term solvency of the U.S. government?
No, not at all. They don't care about Uncle Sam. They're buying it to scalp a tiny profit using massive, massive borrowing.
So the stable hands, the foreign nations, are leaving the table, and the gamblers, the hedge funds, are taking their place.
That's exactly right, which makes the whole system much more volatile. If a hedge fund trade blows up, they have to sell instantly. A central bank holds for long-term strategy. A hedge fund holds for short-term profit. If the trade goes against them, the liquidity just evaporates in seconds.
So if foreign demand dries up, and the debt keeps growing, and the interest payments are hitting $1 trillion, what happens? What is the treatment for this illness?
The treatment is something called financial repression.
That sounds ominous. It sounds like something from a dystopian novel.
It kind of is. It's a fancy term for when the government forces interest rates to stay below the rate of inflation.
How does that help them?
It inflates away the debt. Look, if the U.S. owes $38 trillion, they can't pay it back in real money. It's mathematically impossible. Tax receipts aren't high enough. So they have to pay it back in cheaper money.
So they just let inflation run hot.
Deliberately. Say inflation is running at 6%, but the government, through the Fed, keeps interest rates at 4%. If you are a saver holding that bond, you are losing 2% of your purchasing power every single year.
You're paying a hidden tax.
You are effectively paying a hidden tax to the government to help them reduce their debt burden in real terms. It transfers wealth from savers, from you, the listener, to the state.
So they can't default explicitly. That would cause a global depression.
So they default implicitly via inflation. They pay you back the $100 they borrowed, but that $100 only buys half as much bread as it used to.
So the dollar is bleeding internally from debt, and the doctors are prescribing inflation as the cure.
A painful cure for the citizens.
Which brings us to the third wound. And this one looks less like an illness and more like a weapon being assembled. Let's talk about BRICS and the digital trap.
This is where the autopsy gets really, really interesting, because for a long time, people dismissed BRICS, Brazil, Russia, India, China, South Africa as just a talk shop.
A photo op.
Yeah, a photo op for leaders who didn't like America but couldn't actually agree on anything. A club of resentful powers, I think the New York Times called them.
Right. But in the last 2 years, that has changed. They expanded. In 2024 and 2025, they added Egypt, Ethiopia, Iran, the UAE, Indonesia.
They're building a bloc that controls a massive chunk of global resources, oil, rare earths, food, and a huge portion of the world's population.
And they aren't just taking photos anymore. They are building plumbing, financial plumbing.
We mentioned mBridge earlier. We need to really dive into what that is, because it sounds technical, multi-central bank digital currency bridge, but it's completely revolutionary.
Okay, break it down for us. How does money move now, and how does mBridge change it? Why should I care about the plumbing?
You should care because whoever controls the plumbing controls the flow. Right now, if a company in Thailand wants to buy oil from the UAE, they usually use the SWIFT system.
Which isn't a payment system.
Correct. People get this wrong all the time. SWIFT is just a messaging system. It's like a secure WhatsApp for banks. It just sends a message that says, Bank A promises to pay Bank B. The money doesn't actually move through SWIFT.
The actual money moves through correspondent banks, almost always in New York.
Exactly. The Thai baht gets converted to US dollars, moves through a US bank, then gets converted to UAE dirhams.
So the U.S. is the toll booth in the middle of the highway.
Not just the toll booth, the checkpoint. Because the money touches a U.S. bank, the U.S. government can see it. And if they don't like the transaction, say, if it violates a sanction, they can freeze it.
That is the power of the dollar. It's the weaponization of the financial rails.
That's the whole game. Now look at mBridge. mBridge connects the central banks of China, Hong Kong, Thailand, the UAE, and Saudi Arabia directly. It uses a blockchain-based ledger.
So no correspondent banks,
Yeah.
no trip through New York.
None. The Thai bank puts digital bayat on the bridge, and the UAE bank receives digital dirhams, or more likely digital yuan, instantly. It's called atomic settlement.
Meaning it happens in seconds, not days.
Seconds.
Yeah.
And the cost, it's cut by 50% because you aren't paying the middlemen in New York.
But the biggest feature isn't the speed or the cost, is it?
No. The biggest feature is that the United States is nowhere in the loop. We can't see the transaction, we can't stop the transaction, we can't sanction the transaction. It is a stealth bomber for finance.
I'm looking at the stats here. By early 2026, mBridge has processed over 4,000 transactions worth $55.5 billion.
That might sound small compared to the trillions that move through SWIFT every day, but for a pilot program, that is a massive proof of concept. And here is the kicker. 95% of those settlements were in digital yuan.
So it's basically a superhighway for the Chinese currency.
It is. China is building the rails for the new system. And what's really notable is that the Bank for International Settlements, the BIS, the Central Bank of Central Banks, based in Switzerland, they actually withdrew from mBridge in late 2024.
Why did they pull out? I thought they helped build it initially.
They did, but I think they realized this wasn't just an efficiency experiment anymore. It was a sanctions evasion tool. It was becoming the BRICS bridge.
The West realized they were helping build the weapon that would be used against them.
I think so. So the buys left, leaving the platform fully in the hands of China and its partners.
That seems like a pivotal moment. The West stepped back and the East said, fine, we'll drive.
Precisely. And this brings us to the reality check on de-dollarization, because we hear a lot of doom and gloom about the dollar dying tomorrow.
Right. And President Trump has been very vocal about this. He threatened 100% tariffs on any BRICS nation that creates a new currency to replace the dollar.
And that threat had an effect. Brazil and India, they immediately pushed back. India especially has absolutely no interest in trading the dollar for the Chinese yuan.
They're strategic rivals.
They are. They have border skirmishes in the Himalayas. India isn't going to hand its financial sovereignty over to Beijing. I saw a quote from the Indian foreign minister saying the dollar is a source of stability.
So let's be clear. We aren't going to see a BRICS currency like a euro for the BRICS bloc anytime soon.
No. That idea is stalled. It was a nice symbol, Putin holding up a prototype banknote, but the real weapon is the digital rails, not a physical currency.
So the dollar is safe then?
No. And this is the nuance that people miss. The threat isn't a replacement currency. The threat is fragmentation.
Death by 1,000 cuts.
Exactly. It's Russia and China settling trade in rubles and yuan. It's India buying oil from Russia in rupees. It's mBridge facilitating local currency trades across Asia. It's not that everyone switches to a new king, it's that they just stop obeying the old king.
The system moves from being unipolar, where the dollar is the sun and everything orbits it, to multipolar,
where there are different gravity wells, a yuan block, maybe a euro block, a dollar block.
And in a multipolar world, the U.S. loses that exorbitant privilege we talked about earlier.
Right.
We can't run the deficits anymore because there isn't that guaranteed global demand soaking up all our debt.
The free lunch is over.
This transition to a multipolar world brings us to the next section of our autopsy. The weapon isn't just trade agreements, it's the technology itself. We need to talk about CBDCs versus crypto, the digital trap versus digital freedom.
This is the ideological battlefront of 2026. It's huge.
On one side, we have China. Now, initially, China was pushing a retail CBDC digital cash for its citizens to use on their phones. But that seems to have stalled a bit.
It did. I think they realized that if everyone holds digital yuan directly with the central bank, nobody needs the commercial banks. It was destabilizing their own banking system, so they pivoted.
To what?
They realized the real prize isn't tracking what grandma buys at the market, it's challenging the dollar in global trade. That's why they went all in on the wholesale CBDC model with Enbridge.
But we also see programmable money rising in other places. Kazakhstan has the digital tenge. Brazil has their DREX.
This is the digital trap. Programmable money is fundamentally different from the money we have now.
How so? Explain that.
It means the issuer, the state, can control how, when, and where you spend your money. It's code. They can literally write rules into the money itself.
Give me an example.
Imagine stimulus checks that have an expiration date.
Yeah.
Spend this $1,000 within 30 days or it vanishes. Or money that can only be used for food, but not for travel. Or money that shuts off if your carbon footprint for the month gets too high.
That's incredibly dystopian. It turns money from a tool of freedom into a tool of total control.
It does. And that is why the U.S. response has been so fascinating to watch. For a while, the U.S. Federal Reserve was debating its own CBDC, a digital dollar. But the wind has shifted completely under the new administration.
March 6, 2025. That's a date for the history books.
The executive order establishing the strategic Bitcoin reserve and the digital asset stockpile.
I still look at those headlines and have to double-check that I'm not dreaming. The U.S. government decided to stop auctioning off the Bitcoin it seizes from criminals and start hoarding it.
About 325,000 Bitcoin held by the U.S. Treasury. That makes the U.S. government one of the largest single holders of crypto in the world.
But explain the policy logic here. Why would the issuer of the U.S. dollar want to hold a competitor like Bitcoin? It seems like a conflict of interest.
It's a hedge. It's digital gold. Think about it. If the dollar weakens, if the global system fragments, if Enbridge takes off, the U.S. wants to hold the hardest, most neutral asset in the digital realm.
So if the dollar ship starts to sink, they have a lifeboat already stocked and ready to go.
Exactly. It's a brilliant countermove to China. China is betting on a state-controlled, centralized digital currency network. The U.S. is pivoting to back a decentralized, neutral digital asset. It's a signal to the market that the U.S. is still the hub of financial innovation, not Beijing.
And then there was the Genius Act in July 2025.
That was the regulatory piece of the puzzle. It forbids interest on private stablecoins.
Right, to protect the banks. Explain that. Why forbid interest on stablecoins?
Okay, think about a stablecoin like USDC. It's a digital dollar. It's faster, cheaper, and more efficient to send around the world than money in a bank account. Now imagine if that stablecoin also paid you 5% interest because the issuer, Circle, is investing the reserves in T-bills.
Who would keep their money in a regular bank checking account that pays 0.01%?
Nobody. You would see a massive run on the regional banks. The entire banking system could collapse in a week.
So to save the old banks, they had to neuter the new tech.
They said, you can have stablecoins, they are legal, but you can't pay yield. It's a compromise. They are trying to integrate the new system without completely blowing up the old one.
It's a very delicate balancing act, protecting the legacy system while trying to co-opt the future.
And we are seeing these experiments play out in real time. Look at Bermuda.
Bermuda, the island.
Yes, they are becoming the first on-chain national economy. You can pay your taxes in USDC. They are integrating Circle and Coinbase directly into the national infrastructure.
So Bermuda is the laboratory for the Western version of digital finance.
And Enbridge is the laboratory for the Eastern version. We are literally watching two different futures being built side by side. One is centralized and state-controlled. The other is, well, ostensibly more private and corporate, but heavily regulated.
This brings us to part 5, the safe havens. Because while all this digital warfare is happening, Bitcoin, CBDC, stablecoins, there is an old relic that is having a massive comeback.
Gold.
Gold.
Gold is a quiet winner in all of this. It's the old man in the corner of the room who everyone ignored, but who actually owns the entire building. We're
Okay.
looking at gold prices north of $4,000 an ounce here in 2026.
And some analysts are predicting $5,000 by 2028.
And who is buying? It's not just jewelry stores or, people buying coins. It's central banks, China, India, Poland, Singapore. They have been buying at record rates over 1,000 tons a year for the last few years.
But why? If the world is going digital, why are they buying heavy yellow rocks?
Because gold has no counterparty risk.
Explain that term for the non-finance listeners.
It's simple. If I hold a US Treasury bond, I am relying on the US government to pay me back. I am trusting them.
There's a counterparty.
Right. If I hold dollars in a bank, I am relying on the bank's solvency. If I hold a stock, I rely on the company to perform.
But if I hold a gold bar in my hand?
You rely on physics. It is what it is. It's not someone else's liability. It is the ultimate insurance policy in a world where trust is breaking down.
And after what happened to Russia in 2022, when their foreign reserves were frozen by the West, everyone wants that insurance.
That was the wake-up call for the rest of the world. The weaponization of reserves. The U.S. proved that if you cross them, they can turn your savings to zero with the push of a button.
So if the U.S. can freeze your dollars, then dollars aren't a neutral asset anymore.
They're a political asset. Gold is neutral. Gold doesn't care who is president.
Exactly. And that's why we are seeing repatriation. Countries aren't just buying gold, they are moving their existing gold back to their own vaults. They don't want it sitting in a vault in London or New York anymore where it can be confiscated.
Trust is eroding. That is the theme of this whole deep dive.
Trust is the currency of the realm, and the account is seriously overdrawn. Speaking of trust and high-level strategy, we have to talk about the Mar-a-Lago Accord. Now, this is part speculation, part analysis, but it's buzzing in every financial circle right now.
It is. The rumor is that the Council of Economic Advisors is pushing for a deliberate devaluation of the dollar.
A deliberate devaluation. Why would we want our own money to be worth less? That sounds completely counterintuitive.
It does, until you look at it from a trade perspective. This is the classic strong dollar versus weak dollar debate.
Right.
A strong dollar is great if you are a consumer. Imports are cheap. You can buy cheap TVs from Korea and cheap clothes from Vietnam. It's also great for Wall Street because it keeps foreign capital flowing in to buy stocks and bonds.
But it's bad for factories in Ohio.
It is deadly for them. If the dollar is strong, American-made goods are very expensive for the rest of the world to buy. It kills exports. Trump's entire platform is about reviving American manufacturing, made in USA.
So to do that, he needs a weaker dollar so American goods become competitive again.
Exactly. The proposal is to use tariffs as a threat to force other countries to strengthen their currencies against the dollar.
To revalue them upwards.
Yes. It's what we did to Japan in the 1980s with the Plaza Accord. We basically forced them to appreciate the yen to save U.S. auto manufacturers. The rumor is Trump wants a Plaza Accord 2.0, the Mar-a-Lago Accord.
But there is another piece to this rumor. Something about 100-year bonds.
This is the really aggressive part. The idea is to use this leverage to force foreign nations holding short-term U.S. debt to swap it for 100-year bonds.
Meaning they can't sell it for a century.
Meaning their capital is locked up. It stops them from dumping our debt and crashing the market while we devalue the currency.
That sounds coercive.
It is economic brinksmanship. It's saying, we know you hold our debt, but we set the terms now. It's a very high-stakes game. If it works, it could rebalance trade and stabilize the debt market. If it fails,
it could shatter what's left of the trust in the U.S. bond market permanently. So to recap the condition of the patient, we have a dollar that is losing its immunity with the petrodollar gone. It's suffering from a chronic illness, the debt. It's facing a new, technologically advanced rival in Enbridge in China. And the doctors are arguing about whether to bleed the patient devaluation to save the limb, which is manufacturing.
That is a very apt, if slightly gruesome metaphor for where we are.
So let's read the coroner's report. Is the dollar dead?
No. Let's be very, very clear. The dollar is not dead.
It still makes up 58% of global reserves.
And 88% of foreign exchange transactions. You can't replace that overnight. There is no single replacement. The euro is too fragmented politically. The yuan is trapped by capital controls. China doesn't want to let money flow freely, which you absolutely need for a reserve currency.
So it's not a replacement scenario. It's not the king is dead, long live the new king.
No. The diagnosis is a shift from unipolar hegemony to competitive multipolarity.
Competitive multipolarity. I like that. It sounds like a corporate buzzword, but it actually describes the mess we're in perfectly.
It just means you have choices now. If you are Saudi Arabia or Brazil or Indonesia, you can use dollars. or you can use Enbridge, or you can use gold, or you can use Bitcoin. The monopoly is over.
The dollar is now just one option on the menu, rather than the only restaurant in town.
A very big option, but an option nonetheless.
So let's summarize the forensic findings for our listeners. Point 1.
Saudi Arabia has broken the monopoly. The petrodollar era is effectively over. Energy markets are now open to other currencies, which removes that structural floor of demand for the dollar.
Point 2.
U.S. debt is the chronic underlying illness. The interest payments are crowding out all other spending and forcing the government to rely on financial repression, which is inflation, to manage the burden.
Point 3.
The digital rails are here. Enbridge and CBDCs are actively bypassing the U.S. banking system. They are the new highways that don't have U.S. toll booth or checkpoints.
And point 4.
Gold and Bitcoin are the lifeboats. As the system fragments and trust erodes, everyone, nations and individuals, is looking for assets that aren't someone else's liability.
So, investigative reporter, bring this home for us. We've talked about trillions of dollars in geopolitical chess. What does this reset actually mean for the guy listening to this on his commute? What does it mean for the family trying to buy a house?
It means the financial world you grew up in, the one your parents knew, is changing. The rules are different now.
How so? Give me the practicals.
Okay, first, borrowing costs. If foreign demand for U.S. debt dries up, interest rates naturally have to rise to attract new buyers. That means higher mortgage rates are likely here to stay, higher car loans. The era of free money and 3% mortgages is gone.
We have to get used to a higher baseline for the cost of money.
We do. Second, inflation. Not the temporary kind, but the persistent nagging kind. If the dollar weakens, whether naturally or by design via a Mar-a-Lago Accord, everything we import costs more. Energy, electronics, clothes. The cost of living will likely remain a constant pressure point.
And what about savings? What should people do with their money?
This is the big one. Diversification isn't just for central banks anymore. If the Bank of China, the biggest hedge funds, and even the U.S. government are buying gold and Bitcoin to protect themselves from dollar devaluation, you have to ask yourself why you aren't doing the same, at least on some scale.
You have to follow the smart money.
Or at least follow the scared money. And right now, the big money is scared of the debt and the devaluation. Holding 100% of your wealth in cash or bonds is now, ironically, a very risky bet.
It feels like we are living through a history book chapter that hasn't been written yet.
We absolutely are. Hemingway had that famous line about how you go bankrupt. One of his characters asked, "How did you go bankrupt?" And the answer is, 2 ways, gradually, then suddenly.
And where are we on that timeline?
We have been in the gradually phase for a long, long time. Decades of deficits, decades of outsourcing manufacturing. But with Enbridge now live, with the debt at $38 trillion, with the petrodollar officially gone, we are seeing the mechanisms for suddenly being built.
That is a chilling thought. The infrastructure for the transition is already in place.
It is. The lifeboats are in the water. The question is, who gets a seat?
Well, on that note, we're going to wrap up this autopsy. The patient is stable but critical. The world is moving on. And as always, the most dangerous thing you can do is assume that tomorrow will look exactly like yesterday.
In this economy, that is a guaranteed way to lose.
Thank you for joining us on The Deep Dive. We hope this forensic look at the dollar helped you see the matrix behind the headlines.
Keep your eyes on the data, not the rhetoric.
Absolutely. And one final question for you to mull over until next time. Is your wealth protected for the reset?
A question everyone should be asking themselves.
Thanks for listening. We'll see you in the next Deep Dive.